As promised to you on this edition of Talk Mortgage to Me, I'm going to wind up David Hochberg and I'm going to let him just run at you with everything credit you need to know. By the way, stop doing this and start doing that. That's what Hochberg's going to just unload on you. Hoch, mind blown. Okay, what else? You got to have more behind you.
I got a ton more behind me. So my biggest challenge to helping borrowers that came out of a bankruptcy, that came out of divorce where the spouse blew up their credit, that had a foreclosure, that had a short sale, was reestablishing their credit. And I found a credit union here in Chicago that created a secured credit card, Team Hochberg secured credit card. It's very simple. As long as you're 18 years old and you don't owe the credit union any money and you have $500, those are 3 requirements. You give them $500, they will send you a secured credit card. The best thing about it, 0 annual fee. It reports to all 3 major credit bureaus, TransUnion, Equifax, Experian. After 6, 8, 12 months of you being a good creditor, a good consumer, they'll take a look at that and release that $500 back to you. That's one tip.
So this is like a baby building credit card.
Absolutely.
For anybody, whether you're trying to get started or trying to rebuild.
Rebuild or strengthen or enhance, okay? So here's another tip. So if you have $500, great. I talked to a guy earlier today. He's coming out of a bankruptcy. He has a shoebox with money literally underneath his bed.
Does he live down on Cicero?
No, he doesn't live in Cicero. You better be careful because the people in Cicero are tough and they'll kick your ass. Okay, so here's the other thing. So he's got $1,000. So I'm like, okay, here's what we're going to do. We're going to take $1,000. You're going to call my team at Kane County Teachers Credit Union. They're going to give you 2 $500 Team Hochberg secured credit cards. You know how much money I make out of this? 0. Okay? I make the money when they enhance their credit so I can get them a mortgage. This is the long game. Okay? So you're going to have 2 credit cards going. One's going to be for toothpaste and toilet paper. The other one's going to be for Trojans and transportation. Okay? You put a tank of gas in your car. I'm like, what kind of car you got? I got a truck. All right, you're pumping at least a tank in your truck every week, at least. Great. Boom. Put it on the card. You're going to pay it with that. You're going to tap it down $100. Friday, when you get paid, you're going to go online. You're going to replenish that, so you got $500 left. You keep doing that accordion every single week. Use it, pay it. Use it, pay it. You're going to show activity. Every time you charge it and every time you pay something, you're going to have activity showing up on the credit bureaus. Your scores are going to start going up. Mailbox is going to blow up. You're going to have a party in your mailbox. That's when you know you're back. What you do is you take those credit card offers and you shred them. You do not open up more credit. Then at the same time, they have what's called a secured loan, Dustin. You're going to open up a loan. You're going to take money if you have it, open up a savings account. $1,000 secured loan. It's going to show up on your credit report as an installment loan. How do you rebuild your credit? It's like baking a cake. You need credit, you need credit cards, you need installment loans, you need other types of loans. So now you got 2 credit cards, an installment loan. Every month you're going to throw a Benjamin at it. You're going to knock it down $100 a month. After 10 months, loan's paid off. Guess what happens? The money that you put in there gets transferred to a savings account. You know what you do? Open it up again. You're going to do another one.
Rinse and repeat.
You rinse and repeat. That's what you do. And then by that time, what you want to do is you want to go wide and you want to go deep. You want three trade lines, and you want the 3 trade lines to be deep, meaning every month that you go and you're a good boy and a good girl, you're going deeper and deeper and deeper. What are you doing? You're building a base and a foundation for your credit future.
We could call this Hochberg's hacks.
Yeah.
It's going from 0 to hero in a matter of 12 months.
Bankruptcies, foreclosures. So I use the seesaw analogy. It's like when you have really bad credit, what do? You get depressed, and I'll never get out of this. The credit cards got me into.
I'll never do this again.
Never do this again. I'm staying away from credit cards. The credit card's bad. Listen, credit cards are great. Just like morphine. Morphine's great. I had back surgery, L4, L5 exploded. I was on so much morphine, I didn't poop for a week, and I'm like, Doc, I got to take a crap. He pulled me off. I took a bowel movement. It felt great, okay? He put me on some aspirin. I was going. Here's the thing. If you're living off of morphine, you're at the bottom of an off-ramp with no teeth with a sign saying, please, I'm hungry, okay? The same thing, you could use the analogy with credit. It's not the credit card that got you into trouble. It's how you use that credit card. Just like the person that's living at the bottom of the off-ramp using morphine, right? When used effectively, it's great. Credit cards, when used effectively, is fantastic. So when you have credit and you use it, you will get credit and you will be able to get more credit in the future. If you swear credit off, that's great. You're not going to be able to buy a house. You're going to have a tough time getting a job because they're pulling your credit now when you do jobs. You're going to have a tough time getting a car loan.
How about good luck getting your power turned on without
Correct.
credit?
Right. Last but not least, insurance.
Yes.
A lot of our listeners right now and viewers have no idea that when you go to buy a home, you have to pay the first year's worth of insurance premium up front prior to closing. And they are pulling your credit. And your premium is based upon your credit score. So a 750 credit score, which is pretty damn good, is going to pay lower premium than somebody with a 650 credit score.
Yep.
So that difference could be $800 to $1,000 a year, and that's a ton of money. It's another $800 a month, right? I mean, it's another $83 a month is $1,000, right? So
83, 33, 33, repeat.
33, 30, right.
I'm only good at fourth grade math,
right?
But if you can keep it at fourth grade math, I'm pretty good.
And the other reason we know that because we've done a number of $100,000 a year borrowers, and that's $8,333.33. So we just scaled it down. I did a horrible job when I was doing it. But $1,000 a month difference is another $83.33 that you're going to have to pay because your credit's at 650 instead of 750. So all of the lessons we're teaching today on these videos will help you get a lower credit, get a higher credit score, lower premiums on your insurance, lower auto loans, lower rent, lower mortgage payment, lower mortgage interest rate as well.
Yeah, so it's one of those things like what came first, the chicken or the egg? I'm going to promise you this, your ability to establish credit and pay it on time.
Sure.
That's what came first.
Yeah.
Right? I don't care if it's the chicken or the egg, it don't matter in this case. What matters is, can you show a bank, can you show a creditor or a utility company or an insurance company your ability to pay the money that you signed up to pay and pay it timely?
Right.
And if you can do so, there is a snowball effect that over time, more people will want to extend opportunities to you at the cheapest borrowing costs.
Can I just leave with this?
Yes.
Paying anything late is bad. The worst thing that you could pay late is your mortgage. Because once you pay your mortgage late, that's getting kicked in the groin with not only a boot, but a steel-toed boot without protection on, okay? So when you drop a late 30-day in a mortgage, I'd rather you, if you're gonna miss something, miss a consumer debt instead of your mortgage. I talked to a lady last night, $40,000 worth of short-term SoFi, Lending Club, Lending Tree, all of those short-term rates, high interest rates, $40,000, okay? $1,850 a month for $40,000 worth of debt. That's the equivalent of a $250,000 mortgage payment in today's rates.
Wow.
Okay, so she just paid, we're talking at the beginning of April, she just paid her March mortgage payment this week, okay, at the end of last week. So now she's got 12 months, you gotta go 12 months of on-time payments in order to get a cash out refinance, which she desperately needs. So we gave her some advice, right? He's a truck driver, she's an office manager. You know, he got cut back from his job. Again, you know, they're in a 3.25% 30-year fixed loan, ton of equity. If they would have called me 3 weeks ago, we could have gotten the loan done, got them out of the debt, paid off all their nonsense. And now she's got a late mortgage payment. She's like, yeah, but it's just one. I'm like, yeah, but that's like saying I got one hole in my head, right? That's why I got one bullet hole in my head. I go, we need 12 months for that hole to heal before we could do something, but we got to get you to next April to pay April on time in 2026 before we could do something. So all of these things that we're talking about, the mistakes not to make, and paying your mortgage late is the worst. And if you know that you've got 14 cents in your bank account and you know you continue to take out these high interest rate short-term loans that are suffocating you, you need to call a mortgage professional for help. You can't wait until, they're not hanging on by their fingers, Dustin. Fingers are gone. The skin's gone, the muscle's gone, they're down to the bones, and they're barely hanging. It's like a skeleton hanging on. If they would have called 30 days prior, we would have been able to close the loan, paid off all their nonsense, and they would have been in a better
You know what's
position.
interesting about that is we teach our sales professionals that being shy is expensive.
Yeah.
But even for our clients, our customers, being shy is expensive. We are here to help.
Yeah.
It doesn't matter what life threw at you. Look, life threw that at you. That is your reality.
Yeah.
Don't go at it alone. We are here to help. Team Hochberg is here to help. Don't be shy. Pick up the phone, make a phone call, and at least help ask them to help you find a way to yes.
You know how much the phone call costs?
It's free.
It's free.
Last I checked.
You know how much the advice is on the other side of the call that you make when you're talking to a guy on my team or a gal on my team?
Priceless.
Right.
It is absolutely priceless.
Even if we can't help you, we give you the guidance that you need, give you the direction that you're seeking, and for your benefit, not ours. Okay, we're not going to try to shoehorn you into a loan so we could close your loan. If we could point you in the direction to get you into a position 3, 6, 12 months down the road, we're the long game.
Yes.
Right? We're not here, we have to close your loan to feed our family. I don't hire loan officers that do that, because those loan officers get me in trouble and ruin our reputation that we've developed in this market over the past 25 years. So there are loan officers that will try to get every single loan done because they have to eat, right? My team has to eat, but we're going to do what's always in the best of our borrower, and that's why we're still here. Right?
What's the difference of having a client for life relationship?
Sure.
Or a transactional relationship?
Well, look, there were in 2020, COVID. Remember the beginning of 2020, rates dropped to the high 2s, low 3s, the lowest that we ever saw. The entire industry locked 6 weeks worth of loan in 4 days, and then the rate shot up. We finally worked all that way through until March. And then everybody's like, okay, the boa constrictor swallowed the water buffalo. They finally digested it, and we're getting back to regular. And all of a sudden you start hearing chirping. And, you know, something's happening in China, and there's this disease. There's people on boats. We can't get off of boats. They're quarantined. What the hell's going on? Then COVID, March 15th, COVID hit full frontal. We all thought we were going to die, okay? My team was going, hey, we got to start making lists. We got to start laying people off. I'm like, we're not laying anybody off. I was in the industry, HARP 1, HARP 2, TARP 1, TARP 2. We're not laying anybody off. I would drive downtown Chicago. It would take me 20 minutes to get downtown. It's usually a 40-minute drive.
We call those the good old days.
Oh, the good old days. Nobody was on the road.
Yeah.
It was like it was a desert. It was a ghost town here. So long story short, rates dropped, and we were all busier than hell. Okay, I'm like, they've got to do something, because you could roll a bowling ball down Michigan Avenue and not hit a flipping soul. So long story short, we were busier than hell. Right? 2020, 2021, 2022 record years. There were over 450,000 loan officers. You know the numbers. They just came out. We're down to 95,000 loan officers.
So as we can tell, there is complexity when it comes to credit. Any advice that we could have to a real estate agent or any one of their clients, whether you're a home buyer or home seller, take a deep breath, take a step back, ask for help. That's what great lenders are for. They're for helping you early and often, because a great lender is not transactional. It is a lender for life relationship. They're playing the long game, and the long game is helping you not just with your next transaction, but every transaction for decades to come.